Hi, Julien. As we enter 2026, what risks are top of mind for you and the team?
Hi, Christina. One of the core tenets of our philosophy is to invest with a margin of safety, a gap between price and prospect. And to us, the biggest risk today is the lack of margin of safety in the market. Risk perception is low. Equity valuations, especially in the US, are at all-time high. Corporate credit spreads are tight. And if you look at the VIX, the volatility index, it's also low. Complacency is the biggest risk at a time when darker clouds are accumulating on the horizon. If you look at the macro front, the US budget deficit, after narrowing in 2025, is likely to head back to 6% of GDP. Other developed markets, France, the UK, Japan, are also facing similar debt and deficit issues. It creates pressure on long-term rates and currencies. If you look at geopolitics, the trade war, which triggered volatility last year, is now behind us. Europe is now preparing tariff against China. And you've seen trade tension between Japan and China in the past few days. And on the market front, the AI theme, which has been driving the market higher, also had a very positive impact on the US economy. Almost 40% of US GDP growth over the last 3 quarters is driven by tech sector capex. That momentum might slow down if we see bottlenecks in power generation, electricity transmission, or access to microchips that would negatively impact the US economy. None of those risks feel correctly calibrated in the market today.
So how are you managing these risks?
One of the objectives of First Eagle is to provide resilience in volatile markets. And while we think and monitor some of the macro risk we discussed, we build our portfolio bottom up, one security at a time. And for each of our investments, we try to incorporate different layers of resilience. We have multiple shields to hopefully protect us against risk. One, quality. We focus on quality companies with dominant position, wide moats, and scarce assets. 2, fortress balance sheet. We like companies using little or no debt. 3, alignment of interest. We aim to invest in management team who have a track record of good judgment and value creation, very often founders or their family. 4, margin of safety. We only invest with a margin of safety, a gap between price we pay and our estimate of intrinsic value. We are very disciplined on valuation and the price we pay. 5, diversification. We see concentration as a risk. We diversify across sectors, geographies, and market cap. And finally, gold as a potential hedge or insurance against more systemic risk. It's very much by combining those different elements, those different layers of defense, that we manage risk and provide resilience to our clients. It's a philosophy and a process that has been in place for almost half a century. It's been time-tested, and we apply it with great discipline.
Thanks, Julien. It was great to hear from you.